Lowland's had a good 6 months to the end of March 2021, and it's outperformed its benchmark, which is the FTSE All-Share. If I look at the stock and sector drivers of that, it's been predominantly a complete reversal of what the biggest detractors were in the previous financial year. So to give you a few examples, at the sector level, industrials and financials were the biggest detractors from performance in the financial year that ended in September 2020. But those two sectors have been among the biggest positive contributors to performance in the half year that just finished to the end of March. If you look at the stock drivers of that, those sectors and stocks that are most affected have reversed. So for example, Rolls-Royce and Senior, which were both among the largest detractors in the previous financial year, have both recovered really strongly. And if you think about why, this recovery has really come since the Pfizer vaccine news at the beginning of November. People beginning to think, if we have a vaccine, we might be able to travel again at some stage. The aerospace market might recover. It was historically a very good structurally growing market. Perhaps we can go back to that. So the likes of Senior and Rolls-Royce are really recovering on the back of people thinking maybe we'll all be allowed to fly again, not only passenger travel, but also business travel. And that will really benefit that civil aerospace market. So it has been a good 6 months for the trust, and it's really been driven by those hopes of an economic recovery in those more cyclical sectors like industrials and financials. The first thing to remember with Lowland is that because we have a multi-cap approach, and by that I mean we invest across the market cap spectrum within the UK, so all the way down to smaller companies listed on AIM and all the way up to larger companies listed in the FTSE 100. And because we have that very broad multi-cap approach, we do tend to have more than some of our income peers in smaller and medium-sized companies. Now, what this means in reality is that we have more exposure to domestic UK because smaller companies tend to focus on their domestic market first. It's only natural that companies, when they set up, they focus on the market that's closest to home, and in this case, it's the UK. So Lowland will always have, and does at the moment, have a significant weighting to domestic UK sales. To give you a few rough numbers, at the moment, around just over 50% of the portfolio sales are based here in the UK. And that would be more like 25% for our benchmark, the FTSE All-Share. So you could think of Lowland as being overweight the domestic UK recovery. So if the UK economy is doing well, it should benefit the Lowland portfolio because we have that overweight to domestic UK. Now, in terms of what we've been doing in terms of positioning the portfolio over the last 6 months or so, we have been, if anything, slightly increasing that domestic weighting. So for example, the bank sector is a sector that we've been adding to recently. It's now just under 10% of the portfolio, which would be slightly more than the index weighting, although that is quite modest. And that's a sector that we've not been particularly positive on really for the last 10 years or so since the financial crisis. But we do now think a few things are falling into place for it. To give you a feel, we do still think valuations look attractive versus where they've been historically for the sector. We think some of the legacy issues, think things like PPI have now finally, after many years, rolled over. And we do think that the balance sheets of the sector are broadly in a better place than where they were going into the financial crisis. They've really been built up very steadily over the last 10 years and are now in a better position. So that is an area where we've been adding to the likes of Barclays, the likes of NatWest, the likes of Lloyds, and that's an area that we continue to be quite positive on within Lowland. When I think about UK equities, over-enthusiasm isn't generally a word I associate with the UK market. To give you a few reasons for that, if you look at valuation levels versus, for example, continental Europe, or even more materially versus the US, if you look at how the UK market has performed versus peer developed equity markets, or if you look at sentiment indicators, things like fund manager surveys, really on all of those bases, the UK market would look like it is on a valuation discount. It continues to be unloved, and it has certainly underperformed for the last 5 years or so, really since Brexit. So I do not think that, these things have slightly reversed calendar year to date, but I am really talking quite small levels compared to the degree of, for example, underperformance. So I still think that when I look at all these indicators for the UK, it doesn't give me cause for concern yet, even though there's no doubt about it, the UK equity market has performed well calendar year to date and since the trough of the market last year. But on a number of bases, particularly relative valuations, there isn't that cause for concern yet. I think the other thing to bear in mind with UK equities, particularly domestic UK equities, is that there has been this headwind to performance for the last 5 years. sterling has weakened since Brexit, and it isn't yet back to historic levels. And that has been a real headwind to domestic company earnings. And that looks like it could just be reversing modestly. So that will be a help to, for example, the retailers that import a lot of their costs from overseas, particularly in US dollars. So that a foreign exchange headwind might just be reversing after the last 5 years or so of headwinds. The other thing to bear in mind is things like consumer confidence post-Brexit, business investment. These have been other headwinds towards domestic UK companies that do just gently look like they could be reversing. For example, I'm sure anyone watching this video will have seen headlines about how much savings consumers have built up during this crisis. If even just a small portion of those savings were spent in domestic retailers, online retailers, this would really help domestic company earnings. And I don't think, when I look at the forecast people have in their numbers for some of these companies, I don't think that effect is in there yet. So generally, just taking a step back, I don't think there is that over-enthusiasm towards UK equities yet. Valuations in the portfolio companies that I look at continue to look very modest, and there could just be this reversal of headwinds that have been in place for the last 5 years or so. So all of those things together make me positive on UK equities.